there, accountants. I hope all is well, and I pray that as you are viewing this video, that you're in the best of health and spirit. This video will cover several questions from Chapter 3, which deals with the adjusting process, and Chapter 4, which covers the accounting cycle. So as we learned in Chapter 1, that was essentially the introduction to accounting and business. And in Chapter 2, we analyzed transactions. So in Chapter 3, we were able to learn more about the process, the steps before the financial statements are prepared. We know that there are some adjustments that need to be accounted for. And then in step 4, we essentially learned about the final stages of the accounting cycle, which requires us to prepare the closing entries in preparation for the new accounting cycle. So here in this question, we have a question from Chapter 3, the adjusting process, and it states, the adjusting entry required on December 31st is. So it states the balance in the prepaid rent account before adjustment at the end of the year is $12,096, which represents 4 months rent paid on December 1st. So in this example, we have an example of a deferral, which is a transaction whereby the payment, the exchange of cash happens before the event takes place. So when we are dealing with deferred revenue or unearned income, what essentially happens is that the customer, they pay in advance. So think of it like an auto insurance policy. You pay 6 months in advance. A magazine subscription, you might pay a year in advance. The company did not earn the money. They have a liability and obligation to provide you with the insurance coverage, to provide you with the magazines and things of that nature. And then we also have what's called a deferred expense, which is often referred to as a prepaid expense. So in this case, they paid for 4 months worth of rent in advance. So if we get our calculator and we see here, they paid in total $12,096 for 4 months. So if we divide it by 4, that means that each month there is rent expense of $3,024. So in the event that they never made this journal entry, or they never paid rather for this prepaid rent in advance for 4 months, each month they would need to pay $3,024. So our original journal entry, in the event that we made the journal entry without making a prepayment, our journal entry would be as follows. We would debit rent expense for the $3,024. So we would debit the amount because we know that a debit increases our expense account. And then we would credit our cash. All right, so again, this is if we paid for it on a monthly basis, but that's not the case. In this case, we see that we had a prepaid rent account, and it has this $12,096 balance, which represents 4 months of payment. So we have our T account here. We know that prepaid rent is a form of an asset account because it's going to provide us with a future benefit. So we have prepaid rent. And we have a debit balance because we know all assets are increased on the debit side. So we have a balance of $12,096. And this is as of December 1st. And now the question is asking us as of December 31st. So we essentially know that 1 month's time has elapsed. So at the end of December 31st, our balance in our prepaid rent account can no longer show $12,096 because that would be incorrect. Again, as we learned in Chapter 3, before the financial statements can be issued, we need to ensure that the balances in the accounts are accurate. So this is one of our adjustments. We are adjusting this deferred expense, aka prepaid expense. So we did the math and we know that $12,096 divided by 4 months equals $3,024. $3,024 per month. So based on this information, we know that the balance in our prepaid rent account is going to decrease by $3,024 because 1 month has elapsed, and we need to ensure that at the end of the period when these financial statements are being prepared, they must show prepaid rent with a balance of 3 months. So therefore, in accounting, there's only one way to increase account and there's only one way to decrease an account balance. And as we are dealing with assets, debits increase the balance and credits decrease the balance. So therefore, we would credit our prepaid rent account for $3,024. And then once we make this adjustment, we have $12,096 minus $3,024. And that gives us an ending balance in our prepaid rent account of $9,072. All right, and one way that we can make sure that this information is accurate and it does represent our 3 months, 9,072 divided by 3, perfect, right? So this represents the monthly amount. So we know what our credit is going to be. We're going to credit our prepaid rent account. But now the key thing is, okay, well, hey, what other account are we going to use? We know that as we are dealing with the double entry accounting system, our total debits must equal our total credits. So why did the balance in our prepaid rent account? One thing about accounting is that it is logical. Our correct journal entry would be as follows. We would debit our rent expense for $3,024. And in this example, this is if we paid it on a month-by-month basis. Month by month. But in this case, we paid it in advance. So we're not going to debit cash. We didn't make any cash payment as of December 31st. We made the cash payment on December 31st, and we increased the balance in our prepaid rent account. So our journal entry would be a debit to rent expense for $3,024 and a credit to our prepaid rent account for $3,024. All right, so just a quick recap. This journal entry here up above is when we pay for it month by month and we pay cash. This entry here is essentially that we had the prepaid rent. We paid for 4 months in advance. So as of December 31st, we are recognizing the 1 month of prepaid rent that has expired. And we're decreasing the balance in our prepaid rent account by $3,024. So our correct answer is B. This brings us to our next question. So here it states, which of the following is the proper adjusting entry based on a prepaid insurance account balance before adjustment of $10,101 and unexpired insurance of $4,627? So as we go through this, in order for us to determine what the insurance expense would be, it would essentially be our prepaid insurance account balance before the adjustment minus the unexpired insurance. So in this example here, it's letting us know that our prepaid insurance account balance before adjustment was this $10,101. And then it lets us know that we had unexpired insurance, right? So this is the original balance. And this is essentially how much is left. So think about it like a bank account, right? We started off with $10,101 in our bank account, but we only have $4,627 left. So we need to determine, well, hey, how much money did I spend? In this case, how much insurance was used up? So again, we started off with a balance of $10,101, and our unexpired insurance balance is $4,627, which lets us know that we've used up insurance in the amount of $5,474. All right, so as we go through this information, we now know the correct amount. So we can use the process of elimination. We know that it won't be A, because it's the incorrect amount, and we know that it won't be C. So now that leaves us with choice B or choice D. Now, in order for us to ensure that we are recording the correct journal entry, we need to go back to the fundamentals of our debits and credits and recording our journal entries. So in order to remember such, we have our D, C, Adler. And what this reminds us is that which accounts are increased with the debit and which accounts are increased with the credit. So on the D side, the debit side, our assets, our dividends, our expenses, these accounts are increased on the left side. So therefore, if we need to decrease an asset, a dividend, or expense account, we need to do the opposite, which is to credit it. Now for our credit side, our liabilities, our E, which is for our equity, more importantly, our common stock, is increased with a credit, as well as our revenue accounts, right? And then we can make it even easier. We know assets equals liabilities plus our stockholders' equity. We have our assets, we have our liabilities, and we have our components of stockholders' equity, which is our dividends, our equity, our common stock, our expenses, and our revenue. So our assets are increased with the debit, our liabilities are increased with the credit, and our stockholders' equity account is increased with the debit. So positive impacts to our stockholders' equity, such as common stock or revenue, are increased with a credit, and a decrease to our stockholders' equity is reflected with a debit. So now this brings us back to this question. Again, we have the correct amount, $5,474. And we know that our prepaid insurance account, our asset account, had a balance of $10,101. And we know that there needs to be a decrease to our asset account. So we know for sure, hey, assets are increased with a debit. If we need to show a decrease to our prepaid insurance account, we must do the opposite, is to credit it. So based on this, we know that B is our correct answer. We debit insurance expense for $5,474, and we credit our prepaid insurance for $5,474. Because if we were, again, just based on logic, and I'll put PI for prepaid insurance, the balance was $10,101. If we were to debit prepaid insurance for $5,474, at the end of the period, our balance would increase to $15,575, which is incorrect. Instead, we need our balance to decrease. Debit balance of $10,101, a credit balance of $4,627, and this would give us an ending balance in our prepaid, this incorrect amount. So we would have a credit to our prepaid insurance account of $5,474. And when we do the math, that gives us an ending balance of $4,627. So again, that is why it is so important that as you go through these problems, that you go back to the fundamentals of accounting, because they will continue to apply. So B is our correct answer. And this brings us to our next problem. So here it states, the unearned rent account has a balance of $46,372. If $6,605 of the $46,372 is unearned at the end of the accounting period. The amount of the adjusting entry is. So in order for us to determine, we need to consider our beginning balance minus our remaining unearned rent. All right, so based on this information, it lets us know our beginning balance was $46,372. And then it lets us know that our unearned balance at the end of the period is $6,605. So based on this information, the beginning balance minus the remaining unearned rent, this essentially lets us know the amount of the rent that has been earned. So we calculate it as so. $46,372 minus $6,605. So therefore, as we prepare to record our adjusting entry, the amount of earned revenue is $39,767. So our correct answer is C. All right, so it's very important, again, to understand what exactly the question is asking. So in this question, we essentially see that it wants to know, hey, we started off with this balance of 46,000. We have at the end of the period 6,605 that we have not yet earned. So therefore, the difference between the two represents the rent revenue that we have earned for the period, which is $39,767. So for this question, it asks, net income as corrected is. The net income reported on the income statement is $87,608. However, adjusting entries have not been made at the end of the period for supplies expense of $3,092 and accrued salaries of $5,206. Net income as corrected is. So in order for us to determine the net income, we know we need to factor in these two expenses. So we start off with our unadjusted net income. Unadjusted net income and in this case it lets us know it's $87,608, and from there we know that we need to subtract supplies expense and our supplies expense is $3,092. And from there, we have our accrued salaries, which will also be subtracted. In accounting, anytime a number is negative or it is going to be subtracted, it is in brackets. So I'm putting these in brackets. And in the next step, our accrued salaries, which is $5,206. And once we calculate this, our unadjusted net income minus our supplies expense minus our accrued salaries gives us net income. So we get our calculator. And here we see the unadjusted net income, $87,608 minus supplies expense of $3,092. Minus accrued salaries of $5,206. So that gives us net income of $79,310. So our correct answer is C. So in the event that we fail to record the supplies expense and we fail to record the accrued salaries, the issue is that the financial statements are going to be incorrect. Our expenses will be understated and our income, our revenue would be overstated, right? So it's very important, again, as we learned in chapter 3, we must record these adjusting entries to ensure that our financial statements are accurate. All right, so this brings us to our next question. Here it states, on March 1st, a business paid $5,520 for a 12-month liability insurance policy. On April 1st, the business entered into a 2-year rental contract for equipment at a total cost of $23,320. All right, so based on this information, A asks us, determine the insurance expense for the month of March. So in this case, we see we paid $5,520 for a 12-month policy. So to solve A, we need to do the following. 5,520 divided by 12 months. And this will essentially give us our monthly policy rate. So here we have 5,520 divided by 12. And this lets us know that each month the insurance expense will expire in the amount of $460. And now here it asks for B, determine the balance of the prepaid insurance as of March 31st. So March 1st, we paid this $5,520. So in order for us to determine the amount after the end of the first month, it would be 5,520 minus $460. So if we get our calculator, yeah, 5,520 minus 460. The ending balance of our prepaid insurance after the end of 1 month is 5,060. So same logic that applies for question C, but the key thing here is it says on April 1st, the business entered into a 2-year rental contract for equipment at a total cost of $23,280. So now the key thing in this problem is that instead of the policy being for 1 year, it is for 2 years, which is a total of 24 months. So here we have 23,280 divided by 24 months. So if we get our calculator, 23,280 divided by 24, that lets us know that the rent expense for each month is $970. And now for part B, it's asking us, what is the prepaid equipment balance as of April 30th? We started off with a balance of $23,280 minus the monthly equipment rent expense of $970. If we get our calculator, 23,280 minus 970, the ending balance of our prepaid equipment rental as of April 30th is $22,310. All right. So again, the key thing is you're going through this problem. What is the total amount that was paid? What is the duration of the payment? In the first example, it was 12 months. So we divided the $5,520 by 12 months. In the second example, we paid $23,280 for 2 years. So therefore, we divided the $23,280 by 24, and that gave us a monthly cost of $970. And for B and D, we essentially wanted to determine what is the ending balances for our insurance policy and for our equipment contract after 1 month. So we start off with the beginning balance minus the expense for the month. So here in this question, it asks us, what is the major difference between the unadjusted trial balance and the adjusted trial balance? So for A, it states, unlike the adjusted trial balance, the unadjusted trial balance will continue with the end of period processing, even if it is not in balance. This is definitely incorrect. If our total debits does not equal our total credits, the financial statements cannot be prepared unless it is in balance. So A is incorrect. B states, the adjusted trial balance will show the net income loss as an additional account. This is not correct. C states, the adjusted trial balance will be used to record the adjustments for the period. That is incorrect. So we essentially record the adjustments, but the key thing is that we ensure that the ending balances after we've made the adjustments, those are reflected on our adjusted trial balance. And now D states, the adjusted trial balance includes the postings of the adjustments for the period in the balance of the account. So D is our correct answer. Before the financial statements are prepared, we ensure that the adjusted trial balance accounts for all adjustments, which includes our accruals, accrued revenue, and accrued expenses, in addition to our deferrals, deferred expenses, aka prepaid expenses, and our deferred revenue, aka unearned revenue. So the next question asks, once the adjusting entries are posted, the adjusted trial balance is prepared to verify that the net income flows into the statement of stockholders' equity from the income statement. This is incorrect. All right, so keep in mind, we prepare the net income after we have recorded the adjusting entries. And before we can determine the amount that needs to flow to the statement of stockholders' equity, we first essentially need to calculate our income statement. So that's not the purpose of our adjusting entry. Verify the correct flow of accounts into the financial statements. That is incorrect. C, verify that debits and credits are on balance. So C is our correct answer. A, B, and D, we can't necessarily verify. The key thing with the trial balance is that it helps to make sure that the double entry accounting was followed, but there might be some errors. One key thing, let's say if there was a $500 expense for supplies, however, they recorded it as equipment expense or salaries expense, the trial balance will still tie. So the trial balance does not essentially, let us know if an amount that's recorded is correct. The key thing is that it verifies that our debits and credits are in balance, which lets us know that we correctly adhere to our double entry bookkeeping. All right. So here in this problem, it's asking us to use the adjusted trial balance for Stockton Company to answer this question below. So for this question, we essentially need to determine the net income or the net loss for the period. So here we have this adjusted trial balance. And one key thing, now it's asking us, what is our net income or net loss? So one of the key things to keep in mind, in order for us to determine our net income or net loss, we simply subtract our expenses from our net income. So we will do so. So all of our information as far as our income and our expenses, we find them here. So here we have our revenue, the $6,608. And then here we have our expenses. We have wages, rent, utilities, depreciation, and miscellaneous. So here we have our expenses. So in order for us to answer this question, we subtract our expenses from our revenue. So we start off with $6,608 minus $2,798 minus $801 for our rent expense, minus $324 for our utilities expense, $183 for our depreciation expense, and $83 for our miscellaneous expense. So that leaves us with a net income of $2,419. All right, so if we do it again, 2,798, which represents our wages expense, 801 for rent expense, $324 for utilities expense, 183 for depreciation expense, and $83 for our miscellaneous expense. We have total expenses of $4,167. So our expenses, 4,167. So this gives us our total expenses. And then we know that our revenue is 6,608. So 6,608 minus 4,167. Do the math again, 2,798 plus 801 plus 324, 183. Sorry, 4,189. My apologies. 89. So our total expenses are $4,189. Again, my apologies for the mistake. So 6,608 minus 4,189 gives us our net income of 2,419. So D is our correct answer. All right, so this brings us to our next question. Here it asks, which of the following amounts would be recorded as insurance expense during the adjusting process at the end of Diane's first month of operations on March 31st? So here it states, Diane's Designs purchased a 1-year liability insurance policy on March 1st of a year for $8,400 and recorded it as prepaid expense. Which of the following amounts would be recorded as insurance expense during the end of the period? So easy math. We know that it is going to be a policy for 12 months. So therefore, our journal entry would be as follows. The $8,400 that she paid as of March 1st divided by 12 months. So therefore, at the end of the operations from March 31st, she would need to record the expense for $700. So again, in the event that she decided instead of paying for it 12 months in advance, she would simply pay $700 per month for 12 months. But in this case, she decided to prepay for it for a year in advance. So it would be $700 per period. This brings us to our next question. It asks, prior to adjustment on August 31st, salary expense has a debit balance of $336,410. Salaries owed but not paid as of the same date total $2,680. So now this question is essentially asking us, what journal entry do we need to record? So there's going to be salaries expense. So here's accounts payable. Our liability is not decreasing, so we wouldn't debit it. We are not receiving cash, so we would not debit our cash. Our retained earnings are not decreasing, so we wouldn't debit it. Our salaries payable liability is not decreasing, it's actually increasing, so we wouldn't debit it. We debit our salaries expense because there is an increase of the expense of our employees working for us and we owe them. Accounts payable is a liability. However, this is generally whenever we receive services or goods on account and we owe a vendor. We don't owe a vendor. We have a liability, but not to a vendor. We wouldn't credit our cash because they didn't pay it right away. We wouldn't credit our retained earnings because expenses, are not an increase to our stockholders' equity. It's actually a decrease. We would credit our salaries payable account because we have a liability to pay $2,680 to our employees. And we wouldn't credit salaries expense because crediting salaries expense would decrease our salaries expense. It wouldn't increase it. So our journal entry would be a debit to salaries expense and a credit to salaries payable of $2,680. So now we move on to B, and B asks the effect of closing salary expense as of August 31st. So what would our journal entry be? So we know that at the end of each period, we also need to close the books. So our expense accounts are always increased with a credit. We know that with accounting, it's just like a coin. There's either a heads or there's a tails. There's no in between. It is the same thing when we think about our accounts. For salaries expense, there's a debit side, which is the left, and there's a credit side, which is the right. So when we close the books, we know that we close our red accounts. We close our revenue accounts, our expense accounts, and we also close our dividend accounts. So at the end of the period, since salary and expenses, or any expense for that nature, whether it is wages, utilities, rent, it doesn't matter, our expense accounts are always increased with the debit. So in order to close the account, we would need to credit it. And we credit it into this account called retained earnings. So our retained earnings, we would essentially have to decrease our retained earnings for our total salaries expense. And our total salaries expense would be our balance before the adjustment of $36,410 plus the increase to our salaries expense that we just recorded of $2,680. So therefore, we would close our salaries expense account for the total balance of $339,090. And then we would credit our salaries expense account to zero out this balance. So just to show you guys a visualization, this is what the T account would look like. So we have our T account, we have our salaries expense. We started off with a balance of $336,410. And then again, our employees worked for us for $2,680 worth of salary. And then now at the end of the period, we are crediting the account for $339,090. So now at the end of the period, our balance is $0. Now I'll show you guys quickly with the calculator. $336,410 plus an increase of $2,680. That gives us a total debit balance of $339,090. And then from there, we credit our salaries expense account for $339,090. And that leaves us with a zero balance in our salaries expense. So when we move on to the next period, our beginning salaries expense balance is zero. All right, so in this example, it's now asking us the following is the adjusted trial balance for Miller Company. So in this example, it is asking us to journalize the closing entries and then to prepare the post-closing trial balance. So here we see we need to prepare the closing entry. And as we pointed out, the accounts that we will close out are our red accounts, R-E-D. So we must close our red accounts. So we must close our red accounts. And keep in mind, these are temporary accounts. R stands for revenue. E stands for our expenses. And D for our dividends. All right, so we go through it. We see here, we're going to close out our dividends. We're going to close out our revenue account. And then from there, we are going to close out our expense accounts. Every other account above that, those are our permanent accounts, and they will not be closed. And we know that as we close these entries, they are going to be closed to our retained earnings. So here we see the first part of the entry. We need to determine, okay, hey, we're recording these entries. Here we have the dividends. So we can generalize the entry and we can essentially first start off with our revenue and expenses. So we see here our fees earned, which generally has a credit balance. We want to get rid of it. So therefore, we need, let's see if we can get it down a little more. So our fees earned, we essentially need to decrease this balance for $36,600. And then now the next part of the problem is, hey, we need to also close out our expense accounts. So we close out our wages expense for $12,450. We close out our rent expense for $4,900. Our utilities expense for $3,475. Our depreciation expense for $2,150. And our miscellaneous expense for $1,275. So in order for us to determine the difference, and just keep in mind, the difference between these represents our net income. We have income of $36,600, or revenue rather of $36,600. We subtract our wages expense of $12,450. We subtract our rent expense of $4,900. We subtract our utilities expense of $3,475. We subtract our depreciation expense of $2,150. And lastly, we subtract our miscellaneous expense of $1,275. And that gave us net income of $12,350. So if we think back earlier to our previous problem, our retained earnings is a representation of stockholders' equity, and increases are reflected with the credit. So we have a net income that is left over. So we increase our retained earnings with a credit of $12,350. So we close our temporary revenue and expense accounts, and we transfer, in this case, our net income to the permanent retained earnings account. And now the last part of the problem is to close out our D of the red, our dividend accounts. And in this case, we see that we had dividends of $4,870. So therefore, we debit our retained earnings because it's a decrease of $4,870, and we credit our dividend account to close out the balance for $4,870. So now after we've accounted for these, we know that these account balances will be zero. So we don't record them on our post-closing trial balance. Instead, we would have our assets, liabilities, and our stockholders' equity accounts that remain. So we would have our cash, we have our cash, accounts receivable, prepaid expenses, and equipment. So we have our cash, accounts receivable, prepaid expenses, and our equipment. We see the amount of above: $8,130, $330, $2,750, and $10,400. Right, and then now we start to record our liabilities, our equity, and then we also have a contra asset account. So we have accumulated depreciation of $2,200, accounts payable of $2,700, notes payable of $1,000, common stock of $9,200, and our retained earnings. The beginning balance for our retained earnings was $2,000, but we need to determine what is the ending balance for our retained earnings, because remember, we had an increase to retained earnings, and then we also had a decrease to our retained earnings. So we'll get to that. So from here, account for our accumulated depreciation, the contra asset of $2,200, our accounts payable, $2,700, notes payable of $1,000, common stock of $9,200. And then from there, we need to determine what is the balance in our retained earnings. So here is how we would determine this amount. We start off with our beginning balance in retained earnings, which was $2,000. So $2,000. From there, we add the increase, which was our net income of $12,350. And then from there, we subtract the retained earnings of $4,870. And this gives us an ending balance of $9,480. So this essentially what we just did, that is our statement of stockholders' equity. We start off with our beginning balance, which was $2,000. We started off with our beginning balance, which was $2,000. We added our net income and we subtracted our dividends to get our ending balance. Now, the next step is for us to ensure that our total debits and credits tie. So $8,130 plus $3,300 plus $2,750 plus $10,400. That gives us a total ending balance of $24,580. So now we do the same thing for the credit side. We have to make sure that the credit's high. So $2,200 plus $2,700 plus $1,000 plus $9,200 plus $9,480. Perfect. Our total debits and credits tie. We are good to go. We've closed our red accounts, our revenue, expense, and dividends. We have our permanent accounts and we transferred the balances to our retained earnings, and we are ready to begin the new accounting cycle. All right, so this brings us to our last question. And here it asks, Kirk Enterprises offers rug cleaning services to business clients. Using the following adjustment data and spreadsheet, journalize the required adjusting entries. If an amount doesn't require an entry, leave it blank. So here you see there's some journal entries we need to account for. We need to account for our depreciation expense, wages accrued but not yet paid, supplies on hand, unearned revenue in the portion that has been earned, and our unexpired insurance as of July 31st. So we go through each entry. Depreciation expense of $1,000. So anytime we record a journal entry for depreciation, our journal entry is always as follows. We debit depreciation expense and we credit our accumulated depreciation expense account. So we debit depreciation expense for $1,000 and we credit accumulated depreciation for $1,000. The next part of this entry says wages accrued but not yet paid. So in this example, we have an accrued expense. Our employees work for us and we didn't pay them right away. So therefore, we owe them. So from here, we debit our wages expense and we credit our wages payable for $2,000. We reflect the fact that our employees work for us, and then we account for the fact that we owe them $2,000, so we set up the liability. For C, it lets us know we have supplies on hand of $8,000. So what this means is that this represents the value of the supplies that are left. But here it lets us know that we started off with $12,000. So again, think of it like money. You started off with $12,000 in your bank account, and now you only have $8,000 left. So that lets us know that we've used up $4,000. And in this case, $4,000 worth of supplies. So we debit our supplies expense account for $4,000, and we credit our supplies prepaid account for $4,000. So again, if we think about it like a T account, here we have our supplies. And whenever in doubt, I would always suggest referring back to the T accounts. Here it is, we started off with $12,000. And we only have $8,000 worth of supplies left. So based on logic, we know this is our beginning balance of $12,000. There was a decrease to our balance of $8,000, which means that we've used up $4,000. Hence, our journal entry of debiting supplies expense for $4,000 and crediting the supplies account as we see here for $4,000. So now for scenario D, it says of the unearned revenue, 75% has been earned. So here we see here 20,000 and it says 75% has been earned. So we've completed a portion of our liability. So here we have 20,000 multiplied by 75%. And what this means is that we have earned 15,000. So our liability decreases to our customer by 15,000. And our revenue that we have earned increased by 15,000. And now for the last part of the problem, it says unexpired insurance as of July 31st is 9,000. So here we see our beginning balance for our prepaid insurance was 12,000. And the problem is letting us know that the unexpired amount is 9,000. So what that lets us know, we started off with a balance of 12,000 and we have 9,000 left. So therefore we've used up 3,000. So our journal entry would be a debit to our insurance expense for 3,000 and a credit to our prepaid insurance account of 3,000. And this would be fairly similar to the example that we just saw for our supplies. We start off with a balance in our and I'll put prepaid insurance. We started off with a balance of 12,000. And the problem lets us know that the unexpired portion is 9,000. So therefore, there was a decrease, and we know that the only way that we can decrease an asset account is with a credit. Hence, we debit our insurance expense for 3,000 and we credit our prepaid insurance account for 3,000. All right, so this brings us to the end of our review for exam 2 for chapter 3 and chapters 4. I hope that this video helps. Some key things that I would suggest that you do is anytime you're recording a journal entry, if you want to make sure that you're recording the journal entry, take advantage of DC Adler. Again, the purpose of this depiction is to let you know, hey, I have an asset account and I want to increase the balance. Do I debit it or do I credit it? DC Adler lets you know. So just a quick recap, our assets, our dividends, and our expenses are always increased on the left side, the debit side. So therefore, if we need to show a decrease to these accounts, much like in this example, we needed to decrease the balance in our prepaid insurance. So therefore, we must credit it. Vice versa, we're dealing with our liabilities, our investments, which is essentially our common stock. And then our revenue. Anytime we need to increase these accounts, we must credit it. Hence, we see in this example, D, we debited our liability because our liability decreased. We know that liabilities can only be increased on the right side, but because we performed the service for our clients, our liability decreased, as we see here with the debit, and our revenue increased with the credit. So anytime you're working on a journal entry and you're confused, you always want to refer back to DC Adler. I hope that this video helps. I trust that you would do well on the exam and give you a greater understanding of accounting.